Hi, Steve Walker here from Promise Money. Today I'm going to be talking about development finance and how it might be an awful lot cheaper than you think. Now, this video really applies to somebody who's already involved in development finance or is getting into development finance, and there's a lot of information here also about smaller types developments and refurbs and that sort of thing. So it's to give you a general overview of where the market is at the moment and some ideas on how you might be able to get the best value when the time comes if you're looking for development finance. So development finance, as soon as you say development finance, people think that's really expensive, isn't it? And yes, it's not cheap, but it can be cheap. And the reason I say that is that there are lots of specialist lenders out there, but there are also some high street lenders who will do development finance if you can tick the right boxes. Now, if you go to the specialist sector, there are those lenders that say, well, we won't do anything from less than £1 million. They're looking for the big chunky stuff. But if we've got low loan to value, loan to cost, low loan to GDV, i.e. you've got more skin in the game yourself, there are high street lenders out there that we've got on panel which are lending from 3% plus base. Now that's pretty good when you think the specialists probably start at 5.8 plus base, and most of them are probably around about 7.5 plus base and upwards. So 3 plus base, that's comparable with really competitive commercial mortgages, so it's a good deal. What do you need to be? Well, you need to be experienced to get those rates and be able to demonstrate that. Like I said, you probably need to be at circa 60% of costs, including the purchase price, 50% of the GDV, and everything's got to look pretty good credit, etc., and you've got to have a good strong exit. But those are the rates that are available out there and people don't know about. But let me just talk more generally now about development finance and the types of development, and you might recognise this in your particular journey. So are you experienced or inexperienced? If you're not experienced, then it gets tough, okay? Because a lot of lenders, it's a box they have to tick. We are looking for experience. When I say experience, you've done something similar in the past 1 or 2 times of a similar size. So if you previously refurbished a buy-to-let property, you're now looking to build a block of flats, that's not really similar. That's not going to cut it. However, there are lenders that will look at that, but you pay a little bit more for it. So getting experience is important and being able to demonstrate it. If you haven't got the experience, then it's who you're partnered with. Who's going to be doing the build for you? Do you have the right sort of contract in place with them so that they are committed to it? Even better, if you're partnering with a builder, do they have skin in the game? Are they putting money in? Will they get some of the profit? And as a result of that, you are getting their experience vicariously as part of that deal, because the lender will say, well, if they've got skin in the game, they have got experience, so that's good. So that's something to think about. But very often you've either got experience or you haven't, and you often want to do the deal on your own. You don't want to cut the builder in for any of the profit. So that's the first thing. The second thing is, well, how much skin in the game have you got? Are you looking to max out your day one borrowing? Maybe you're buying a plot, and I'm assuming it's got planning. If it hasn't got planning, there are strategies for that as well. But you're buying a plot, so you're looking to get the maximum at day one. You're then looking for the maximum build costs, and in that scenario, a lot of lenders are looking for you to have more skin in the game. So if you pull out the max, you're going to pay more. If you already own the plot, then that's really great, because you're already sitting on a chunk of equity. So when it comes to getting that first drawdown to do the first amount of works that you're looking to do, the lender's going to be feeling really comfortable about that, because they haven't put money into it for you to be able to buy it in the first place. You've already got that equity there, so that makes them feel an awful lot better. And then it's, what are the costs? What's the GDV? Do the numbers all stack up? But bear in mind, if you've got other assets or you can leverage cash from elsewhere, they will take cross charges on other assets, which could include other commercial property, residential property, your main residence, etc. Or you might be able to raise money separately more cheaply. For example, why would you take a development loan secured over your main residence at a higher rate if you could remortgage your house, or maybe take out a secured loan, a second charge, at a lower rate and use that to help fund the development? So there's strategies that you need to put together. And of course, at an early stage, if this is something that you're doing, talk to somebody about how you're going to put the whole thing together and what your assets are and how you might be able to make yourself look as attractive as possible to lenders, because it is not a given that lenders will lend to you. I will caveat that with, we do have lenders which will lend to inexperienced developers, providing everything else stacks up. So we've got to get you looking right. And looking right could be the difference between 3% plus base into, I guess, where your specialists are starting at 5.5 plus base, and they're looking for experience, and they're probably £500,000 to £1 million upwards loans, to 7.5 plus base, where probably you need a little bit more experience. Now think about that difference between 3% and 7.5%. That's 4.5% difference on your rate. That's a big jump. And then even higher than that, if you're looking to do something a bit quirky, like finish off a property that's already part built, or it's a small regulated development, maybe it's a place, property that you live and you're looking to develop that, then you could even be paying higher rates than that. So it's horses for courses. It's about understanding what you're looking to do and get it looking as good as we possibly can at the outset. A few things just to be wary of. If you start the development and then come looking for money, some lenders say we like to be in at the beginning. We don't want to come onto a half completed development, because in their minds that's a failed development. What was your plan? You must have had a plan at the outset. That hasn't worked. Why do you need us right now? They also worry about what's happened in the build prior to them getting there. So they get nervous about that. So it's best that you've always got your lender on board from the outset, even if you don't need them, because you can get terms and have it all set up and an application in place for when you do need them. And going on to that point, you probably don't want to use the developer's money at the outset and pay interest on it if you've got your own cash. So it makes sense that you want to use your own cash first and then use the development money when you've run out, but get them involved at an early stage, because that can save you money. Other factors that they're going to take into consideration, as well as your experience and the GDV and all of the costs, etc. They're going to take into consideration your credit. So if you've got good credit or bad credit, it is a factor. They're going to take into consideration your assets, because very often on development finance, they're going to want personal guarantees. Well, a personal guarantee is worthless if you don't have any assets for the benefit of that guarantee. So personal assets is also important. Your exit is important as well, because if you are exiting and it's a commercial deal, some lenders, to offer the best rates, are going to say, well, we'd like to see that pre-let. So have you already got an agreement in place with somebody who, once you've built it, is going to take it off your hands? And that could be the case with a commercial. You could be building it specifically for a high street name to move in there. Specialist lenders are less worried about that. It all affects the rate. And is it sale or is it refinance? That can affect the rate. Lenders prefer sale. It's a little bit more certain. So those are all the factors that we're going to throw into the pot to come up with the best solution for you. But we need to throw them in early so that it's all been considered before you embark on your journey. I'll work on the assumption that you've already got your plans, you've got your planning, etc. I'll just now talk very quickly about, I guess, the loan bands and the types of development finance. Your specialist lenders, a lot of them, are going to start at £1 million. They're not interested in anything less than £1 million. But above £1 million, you've got a good choice of lenders, including high street lenders. When I say including, there aren't many of them. There's one or two who might look at it, but if we know how to present it properly, that's where the best terms are. So £1 million plus, that's the sweet spot for what I would call proper development. You know, a whole load of houses or some sort of large commercial enterprise, something like that. You've then got £500 to £1 million where there's a few specialist lenders playing in that sector, but you get less choice. High street is still in there, but it's got to look right. It's got to have the right GDV, it's got to have the right costs, it's got to have the right numbers against it, have the right experience and the right exit. Then we come down to smaller deals, which very often can also be regulated. So the scenario where somebody's bought a plot of land and they're going to build a house for themselves, that's regulated under by the Financial Conduct Authority, because you're going to live there. Most development lenders are not regulated. They're not authorised by the Financial Conduct Authority to lend. Therefore, they can't lend to you even if they wanted to. So that means your market comes from that down to that. You probably didn't see that bit, but it comes down to that. Regulated lenders, there are very few of them. So that is a factor too. And going smaller again, you get the scenario where it's regulated because somebody's built a house and they're looking to built a house, but then halfway through they run out of cash, so it becomes a failed bridge effectively. So who's going to do that? Or you might have somebody, and it shouldn't happen, but it does. Somebody's bought a house, taken out a mortgage to buy it, and knocked the place down without telling their mortgage lender. The mortgage lender thinks there's a lovely house there. It's actually a field, or it's part built, and then they run out of cash. And because there's a mortgage in place, they need a second charge. So then you need a second charge, regulated development bridging loan. Again, there are lenders that will do it, but it's more complicated. And then finally, we've got what we're seeing an awful lot more of, which it isn't really development, it's more of conversion or refurbishment. So converting commercial to residential, that can be development if it's big enough and it's a big chunky job, and there's some lenders who specialize in that. I've done a video on that actually, converting from commercial to residential, multiple numbers of flats. There's some really great products for that. And then you've got your refurbishment bridging, which is maybe just one property. I'm going to buy a buy-to-let property, I'm going to do it up, and then I'm going to either sell it or refinance it. There's an element of development in there, but it doesn't work quite the same way as development money in most cases, because they give you all the money at day one rather than in tranches, which is what you're looking for in development. But often, you don't want it in tranches, you want it in day one, because you bought it, you're going to wallop it, do the work, and then you're going to exit the bridge and either sell or refinance. So the key message for this is, look, there's some really good development deals out there, but you've got to do your prep and you've got to get your deal looking right for those lenders. If you can't, and a lot of people can't, there's still lots of appetite, but the larger deals, £1 million plus, there is more appetite. Non-regulated, there's more appetite. First thing I would do is pick up the phone and talk to a specialist to say, right, this is where I'm thinking of going. What do I need to do to get my ducks in a row to give me the best options? We sometimes get developers coming to us and dictating to us exactly how the deal is going to be done, because that's what they've got in their head, and that's fine. We sit in the middle. We'll say, well, if that's what you want to do, we'll go out to the market and find somebody who's going to do that. But it's much better if we can help educate somebody at the outset and say, well, if you did it this way, it might give you more options. Development finance, it doesn't have to be that expensive, but do it right, and you've got some really good options. That's it on development finance. Please don't forget to like our videos, subscribe to our videos, and go check out YouTube, Promise Money YouTube, and our website promisemoney.co.uk for more information. Hope that was useful to you, and I didn't speak too fast because I did go pretty quick, didn't I? But time is money, isn't it? So thanks a lot for watching. Bye bye.